Hi, welcome to the end of the financial road part 3. Are we reaching the end of the financial road? Well, let me present the case to where I believe we are. As ever with all of this stuff, do your own research, but I think it's quite compelling that something is seriously wrong. So let's get into it and start by having a look at what's going on. Now, if you've not seen part 1 or part 2, I suggest you go back and have a look at these first, just to bring yourself up to speed, because these are the two videos recorded in 2016, which is about 2.5 years ago, and now it's taken this long for things to start to unravel. So let's move on, and let's start here, back on the 27th of June 2017, when the Federal Reserve Chair at the time, Janet Yellen, was interviewed about whether she thought the markets were sound, the banking system was sound. Federal Reserve Chief Janet Yellen on Tuesday the 27th of June said thanks to a number of safeguards enacted in the wake of the 2008 financial crisis and the subsequent Great Recession, she doesn't believe another financial crisis is looming on the horizon. Will I say there will never ever be another financial crisis? No, probably that would be going too far. But I do think we're much safer, and I hope that it will not happen in our lifetime, and I don't believe it will, she said. And this was, June the 27th, 2017. But unfortunately for Yellen, things are not what they appear to be, because as far as I can see, the banking crisis of 2008 was never sorted. It was a gaping wound that basically had a plaster overlaid. It was never addressed, it was never dealt with, and things have just got worse and worse. So this is a chart that I've compiled. This was in part 1 as well, where I showed the relationship between the Federal Reserve's balance sheet and the rising stock prices, and how the two were inextricably linked, and all of the corrections in the market are periods where the Federal Reserve stopped printing money, or QE, and once they resumed it with QE1, QE2, QE3, then prices continued to move higher. Now, in the first video I covered all the way up to 2016, where they started to pull back with the QE, and they were trying to normalize the balance sheet. Well, in 2017, they managed to do this for a while, but you can see how the volatility increased in the market. And in the end, they had to resort to printing more QE, this time 60 billion of treasury bills, which started late in 2019. And you can see there the printing of money again and the last throes of the stock market. Now, there was a problem, because back on the 26th of September 2019, something happened in the repo market. Now, I'm not going to go into all the details of the repo market, but basically it's liquidity that is provided by the Federal Reserve for overnight lending for all of the major banks. And something happened where prices actually, or the rates, spiked to 8%, and they hadn't been this high since 2008 and 2000. Let's just talk about 2000 and 2008. This is the dot-com bubble, and this was the mortgage fraud bubble from 2003 to 2008. And you can see when the market collapsed, the repo rates also dropped, and then this happened. So already something is wrong in the market. This is before the virus got hold globally, the coronavirus, that is. So the catalyst for me was nothing to do with the virus. The straw that broke the camel's back was this. And what happened subsequently, as we move forward here, I've actually created this chart for you. See, the Fed said in September that they were only going to print 75 billion per night for the repo market for 5 days. Well, that 5 days then became October, and it actually increased to 120, November 150, 175 in December. They did drop off a bit in January and February, but now they're up to 500 billion a night. And you'll see why that is the case as we go through the video. But up until the virus struck and the market started to fall apart, you could see that, again, the Fed had lied. They said they only needed to print for 5 days, and then it's just increased and continued. So again, this adds to my case that the market is broken, that the whole of the financial system is broken. So let's move on and have a look at this in another way. So the repo market, the Federal Reserve put on offer how much they want to lend on the overnight. It started at 75 billion and then has increased to 500 billion as of recording the video. But you can see there was no problem until we got to September. So again, we go back to this thing that there was never a problem with the market, or the banking system, I should say, until the 26th of September. As I'm going to keep saying, this for me is the catalyst. This is when the problems actually started. All the way through, as we saw before, dot-com bubble, the mortgage fraud bubble, everything was fine until the repo rate spiked. And the reason they spiked is because the liquidity in the overnight banking system had dried up. The banks couldn't lend to each other, so the Fed stepped in to do this for them, to keep them afloat, basically. Well, not afloat, I suppose a bit too strong, but to keep the liquidity in the banking sector. But as you can see, this is now reaching silly levels. The banking system was never cured. It was just delayed. One other thing you should keep in mind with regards to the Federal Reserve's repurchase agreement operation details that can be found here in this website. Just search for the Federal Reserve Bank of New York and you will find the repo details. But one thing that's come to light, if I just scroll down to the bottom here and go to the previous periods and go all the way back to this will do to November, you will see that the majority of the terms of these repos where the banks are lending not only on the overnight but also for a number of days as well, and you'll see they average between 13 and 14 days. And then when we got into December, you will see that we started to get 42 days where they were lending up to 25 billion and 28 days there as well. So all of a sudden we've gone from not only the Fed putting the repo back on, or reintroducing it since 2007 and printing 75 billion a night, they also then extended the days that they were going to lend the money for. So you can see there, 32 days, 50 billion. And this to me just says there's something seriously wrong when they're starting to do this. But as we come to where we are now in the midst of this crisis, just take a look at this. Not only have we gone up to 500 billion, which we can see there, 775 billion, 500 billion. But look at how long the days are now as well. We're at 84 days. They're lending 500 billion on 84 days. And have been doing this since Friday the 3rd, actually. 4th there. I mean, wow. So you can see that there's no end to the madness as far as the repo market is concerned. So things were going well in the stock market, as we saw from the charts, but after September the 26th, they managed to hold. They printed 60 billion a month in treasury bills. They said it wasn't QE4. Well, it may not have been, but they were still buying assets and adding them to the balance sheet, as we saw in the graph in the relationship between the S&P and the Fed's balance sheet. But unfortunately, the nail in the coffin came with the coronavirus. And as this started to spread around the globe, it just destroyed the markets. And we've seen this carnage going on in the last few weeks. And you can see the headlines here, and also prices dropping sharply in the markets as a result of this. The problem is the Fed's got nowhere to go. As you can see here, they've just gone into complete supernova with printing. First of all, they've now expanded the overnight repos to 1.5 trillion. That's for the repo bailout. Says it's not QE, but it is QE, as you'll see in a moment. And then the Fed reduced interest rates. We're going to come on to that in just a moment. So they not only reduced rates, but they also went on to print 700 billion. Now, this announcement took place on a Sunday afternoon, which is unprecedented. Normally they wait until they have a meeting, but the panic has set in. And having cut rates to zero, having cut them already before this announcement, they then went on to say that they were going to print 700 billion per month, 500 billion QE, 200 for mortgage-backed securities. Back to the mortgage thing again. However, this wasn't enough. The market went sailing south on this announcement. I sat and watched it open on the Sunday evening, thinking the market would go up 1,000 points. It didn't. It dropped 1,000 points. The market went limit down. The circuit breakers came in, and the market was stopped. So as this wasn't working, and things got worse going forward, and then as of yesterday, the day before recording this video, you can see there they've now said that they're going to print 125 billion, and this is the terrifying thing, every day. Can you believe this? They're actually going to print 125 billion every day. Now, the whole of QE3, I think, or was it QE2? Trouble is, you forget now, there's that many of them that they've done. But the whole, I think, of QE3 was 85 billion for the duration, which was many months. And here, they're talking about printing now 125 billion per day. So this is going to send the Fed's balance sheet into orbit. There's no doubts about that. And with this, they intend to buy credit card debt from the banks and auto loans and what was the other one? Student loans. That was it. How can this continue? That's the question. How can they continue to just keep printing and printing and printing? The dollar's gone through the roof. Gold prices have gone down as a result. And the reason for the gold price moving low, which I'm going to come on to later, is simply because of margin calls. And also it's inversely related to the US dollar. So this has continued, as you can see here, it's just going on. You know, you've got open-ended QE now, just keep the printing presses going. You know that it's not the printing presses, but that's how the masses and the general public perceive it, that they're printing notes and coins, and that nothing could be further from the truth. This is just zeros on a computer. And you can see there, it's just they're buying everything to try and keep the markets afloat. It's quite staggering. You can see there they bought a record 107 billion in securities in one day. And as it says there, the balance sheet has exploded, and it certainly has. There you can see that whatever they're trying, the futures keeps crashing. And even at the time of recording, it's not making any difference. The markets are not moving back to the upside. The markets no longer believe that by printing all of this money can the be a resumption and move to the upside. So another thing they've done is reduce interest rates during this crisis, and it's not only the Fed, but every single bank around the globe has reduced their interest rates. So let's have a look at a few of them. I mean, there are too many to look at, but the picture is exactly the same. So the Fed spent nearly 2 years trying to get the interest rates up to 2.5%, and in a matter of a couple of weeks, or days actually, never mind, well, it's weeks, we'll go with weeks here, 2 weeks I think it was, you see the rate is now back down to 0.25. So what took 2 years to actually move to the upside and normalize the balance sheet, which failed miserably, because the market needs this monetary methadone that has been referred to by even one of the Fed members. I think it was Fisher, Stanley Fisher, that said this, and then soon after he didn't have a job once he spoke of it in terms of a drug that the market needed, and it's certainly the case. Here we've got the Bank of England, and we were already sitting in the lows. And now we're more or less down to zero as well. And this is the way these things work. As you can see here, they tried to increase rates, and now we're back down to, as I say, 0.1, the lowest level in 35 years. And then it just goes on. The ECB, unfortunately, can't do anything with rates because they've already done it. Another reason why I've said so many times that the European Union is doomed, not because of the countries in it, but because of the central banks and recklessness of just reducing rates and printing money, which they've continued through this crisis as well, having printed 850 billion, I think it is. They've got the Canadian bank there. Again, you're seeing the same picture. This is the same around the globe, 0.75. So it's sort of begging the question, what do these central banks have left that they can actually do? We'll come on to that in just a moment. But again, you can see the Australian bank dropping rates. They're also printing money as well. Their printing presses are smoking. The Bank of Japan, well, they're already negative. Minus 0.1 for the Japanese bank, and the New Zealand central bank as well. The New Zealand central bank as well down at 0 or more or less, as you can see there. So things aren't panning out the way they wish them to. So it's not looking good. Not only are we got the printing presses on 24 hours a day, but we've also got interest rates more or less down at 0. Will they go negative? Well, they can do, as we've seen with Japan. The Eurozone has negative bonds, a lot of them. So yeah, there's a bit left on the downside for the interest rates. But really, are the central banks out of ammunition? Well, it's interesting actually. So I thought, well, let's go down the road of having a look and seeing if they've taken any measures to hedge the recklessness of printing trillions and trillions of dollars, euros, pounds, etc., whatever currency. In part 1, I think it was, of these videos, we looked at the central banks, and in 2010 the central banks started to buy gold. Now, they've not been interested in this from the year 2000, which, as far as this graph goes back, they've been busy selling it, and in particular Gordon Brown had been selling it in the UK, sold out all of the UK gold, or a majority of it, at $285 an ounce. And at the time of recording this video, it is now sitting at $1,500. The central banks globally, you can see, have been buying gold. They stopped in 2016-17 because the Fed were normalizing the balance sheet, and also Trump had been elected, plus they were increasing interest rates. However, 2018 they changed their minds, and they've been buying it by the tons ever since, because at some point down the line they are going to have to resort to some sort of to bring confidence back to the market. Whether they reset the system using gold or not, who knows? I have no idea. Bring a gold standard back, the one that they removed in the video part 1 of these videos, when Nixon removed the gold standard. So we'll have to wait and see. But something that is really fascinating that's come to light is a couple of weeks ago I was looking at the gold-silver price ratio. And basically it's what this means is for 1 ounce of gold, how many silver coins can you actually buy for the same amount of money? And it wasn't so much the fact of how many you could buy, but it was the world events that had taken place that actually caught my attention. I mean, if we go back to here, I mean, this goes back to 1900. The ratio was that you could buy 8 coins to 1 ounce of gold at the end of World War One. But then something happened here. This major event took place where we were at 99 pieces of silver, or 1 ounce silver coins to 1 ounce of gold. And then as the war ended and we put man on the moon in 69, we came all the way back down to 18 ounces of silver to 1 ounce of gold. And then from 69 through to 91, when the first Gulf War took place, again, when we get to these sort of lofty levels of 99, 89, there have been wars, major events taking place. So everything's been fine since 2011. silver prices were moved up to $50 an ounce, back to the 1979 levels when the Bunker Hunt brothers tried to corner the silver market. Didn't quite break it. And then there's been all sorts of manipulation of the silver price and fines by Deutsche Bank being fined $38 million, JP Morgan, the list goes on, manipulating the price back down to, of late, $11 per ounce. But anyway, the thing that fascinates me here is that the record at the time of recording is 125 1 ounces of silver to 1 ounce of gold, never seen before. Well, given the backdrop of what's going on, does this mean that we're going to war again, as we've got the two here and here? Well, personally, I don't think this is the case. I think this is the change of the financial system. The financial system is broken, and the only way forward is going to be some type of reset, and to bring the confidence back into the financial system, some sort of backing with gold and silver. And that's what this extreme is showing. The lack of interest in silver, the manipulation of silver to the downside. Go and have a look at GATA, which was set up by Bill Murphy, and have a look for some interviews on YouTube with Bill Murphy, and you'll see what I mean about the manipulation of the silver price. Yeah, so what this is showing is that there is something that is coming. There has to be, because of this extreme, as we can see from the previous ones. What it is, I don't know, but that would be my guess, that they're going to continue to print. The markets aren't responding to the 125 billion a day, the 700 billion a month, the drop in interest rates, the cut in interest rates globally. All of the central banks printing money to shore up the economies because of the coronavirus that has unfolded and sent everything into a tailspin. Can they pull something out of that? Who knows? So this video has gone on for 20 plus minutes. So I'm going to conclude here. As I say, there will be daily updates of these events unfolding. This is, as I say, part 3. So you are up to speed as you watch the daily alerts and in real time as the carnage continues to unfold, and we see how this moves forward. So where does this leave the average investor like you and I? Well, in part 2 I spoke about owning physical silver and gold to hedge against a crash. We've seen the gold-silver ratio move higher. We've seen central banks have been buying gold by the ton since 2010. Well, guess what? Now it's very difficult to find any physical silver from the bullion dealers that I've dealt with over the last few years. You can see they are currently out of stock and sold out. And this isn't just a one-off. When the silver has come in, yesterday before I recorded this video, the bullion dealers had some silver, and by the time I placed an order, it had already been taken up. And this is the rich, the elite, those in the know, who can see that there is something seriously wrong with the financial system. It's falling apart at the seams. The fiat currency that we've had for the last 50 years, they managed to drag it out another 10, is now coming to an end. And people, as I say, those with any sort of acumen as far as understanding how these things work, or being told how they work, are seeing the physical silver and gold being bought up by the lorry load. So there you go. We'll see how this pans out over the next few weeks and months. So we'll be doing a daily update to follow on from these now. I just wanted to bring you up to speed from 2016 in this part 3. So with that, I will see you in the daily alert. As ever, thanks for watching. See you in the next one.